Iran, through state media today, did say that they have responded to the 15-point ceasefire plan put forward by the U.S. that Special Envoy Steve Witkoff did confirm, indeed, that the administration had sent over today. That said, Iran has been rejecting much of what was actually in that plan, of course, making demands of its own, including recognition of its control over the Strait of Hormuz, something that's frankly a non-starter, not just for the U.S., but for other players in the region.
Hello and welcome to the Week Ahead on Nomura Podcasts. I'm your host Andrew Ticehurst from our Global Markets Research team, and today's Friday the 27th of March. The conflict in the Middle East remains a critical focus for markets. Headlines this week have waxed and waned, and you heard a recent snippet there from Katie Lyons from Bloomberg. And we've seen pretty consistent reactions across most asset classes in markets too, with oil and bond yields falling and equities rising when hopes for a resolution rise, and vice versa. Now, we are putting this podcast to bed on Friday, the 27th of March, and I just flag, of course, that weekend developments could be important. It's quite possible that markets again reopen sharply higher or lower come Monday morning. It's a tricky and unpredictable environment, and I think investors and traders have been in risk reduction mode with bid-offer spreads widening and liquidity down. And with the conflict extending, we are starting to see some March data revealing some impacts, and we've got more of that to come over the coming week. So this week I'll be chatting with members of Nomura's global research team. Ruchir Sharma in New York, Andres Stepaniak in London, Hannah Liu in Hong Kong, and Yuichiro Nozaki in Tokyo. I'll be getting their latest thoughts on the conflict, how it's impacting their parts of the world, and the data ahead, including an important upcoming US payrolls report. And finally, just a flag, Nomura has been hosting its annual central bank seminar in Japan this week, and we plan to bring you a special edition podcast featuring interviews with a few of our special guests. So do keep an eye out for that one. And with all that said, let's dive in. So let's get going. We'll start with the US, and I'm joined here by Ruchir Sharma from Nomura's New York-based research team. Ruchir, welcome. Now, let's start with the Middle East and the latest developments. I know the situation's very fluid, but as we record this little snippet section here, and it's Thursday afternoon, early Thursday evening, New York time, what are your thoughts on the latest developments here and how that's impacting the US?
Hey, Andrew. So the latest on Iran is, again, as you said, that the situation has been very on and off. We've seen signs of escalation. We've also seen signs of diplomacy. Taking a step back and looking at it, so earlier this week, President Trump said that he was postponing strikes on Iran's energy infrastructure. So because of what he described as constructive discussions with Iran. So he also said that US was discussing and negotiating with a senior Iranian official who was not the supreme leader. But later we saw that Iranian media and the Speaker of the Parliament himself, they pushed back against it. So after that, we saw that the US presented a 15-point plan to end the conflict, which Iran rejected. And lately, we've seen that Trump turned a bit aggressive, casting doubts on whether a deal was possible. And he also threatened intensified military actions. So yeah, overall, the backdrop remains very fluid and quite tense. So from a market perspective, again, oil prices have remained elevated. There have been concerns about supply choke points, especially fertilizers and shipping routes. And lately, actually, there were reports that Yemen's Iran-aligned group, they could probably join the war, which raises the risk that the Bab al-Mandab Strait, that's a key passage towards the Suez Canal, that might be disrupted. So that's another thing that we are monitoring. Another thing that we have seen is that the administration over here, they've taken cognizance of the price pressures that have started to build up. So last week we saw Treasury Secretary Bessent talking about SPR release. We saw some easing on Russian energy and Iranian oil that was already on water. This week we saw that the US removed some sanctions on potash companies, and Bessent also said that US insurance program to support shipping through the Strait of Hormuz, that's likely to begin soon. And talking about like how it impacts the US, I'd say that economically, US still looks relatively insulated from this kind of a shock. So higher energy prices, again, could support more investment in energy-related infrastructure. But that likely only happens if producers believe and they have confidence that these prices, they'll stay elevated for some period of time. As for inflation, we think that the direct spillover into core inflation, that's pretty limited. But what the Fed would be concerned about is how it impacts longer term inflation expectations. And that's something that bears watching.
Okay, got it. Good one. Thank you. Now, look, in terms of how the economy is holding up, we'll get some clues about the health of the consumer next week. Vehicle sales and retail sales data will be coming out. Have you got any thoughts on what those data might show?
Yeah, so over here, consumers looking pretty solid. So as you said, we have February retail sales data, and we think consumption remained steady prior to the Iran war. So we think that retail sales rose 0.5% month on month, driven by a broad-based spending. So we've seen that tax refunds, and we also had President Day deals in February that were a tailwind for consumption. And looking at the data for March, so we have vehicle sales as well for March, and we expect another strong print. So going into March, we've seen that high frequency data that's pointing to steady sales in the first couple of weeks. Overall, the consumer health is fine. We had strong payroll income in the past couple of months and elevated tax refunds. And I think these are important factors because they'll probably help cushion consumer spending against the shock of higher energy prices in March. And also, since we're talking about consumers, so let me reiterate this, and I think we've mentioned this many a times, that we do not believe that this is a feast or a famine or a so-called K-shaped economy with only high-income consumers driving spending. In fact, again, high-frequency data from cards and consumer surveys and earning calls from various companies that still suggest that consumption has remained robust across all income levels.
Got it. Thank you. And look, Rashir, finally, last question. Next week, of course, is payrolls week, so we'll have to cover that one. I recall that the February payrolls report was a bit softer, but we saw that mostly as payback from strong January numbers. But what are we thinking about the March data here?
Yeah, so I agree with you. So January was surprisingly strong. February corrected sharply lower. But again, taking a step back and looking at broader data, it suggests that the underlying trend of job growth that's fairly steady rather than falling off a cliff. So our take on the March jobs report is that payrolls growth, they likely rebounded modestly to around 55K. So this month, the end of nurses' strike, that should provide some support to these numbers, although that's likely to be partly offset by a drag from some normal weather after earlier distortions. So on the unemployment rate, it's going to be important, and we expect it to hold broadly steady, effectively rounding down to 4.4%. So what we are seeing over here is that layoffs are still running near cycle lows, but measures of job finding, or what you would categorize as labor demand, they've been more mixed. So again, unemployment probably stays range bound in the near term. So that said, again, there's a slight risk that it rounds up to 4.5, but that's partly because the partial government shutdown that we had, it affected the Department of Homeland Security, and some employees there, they might show up as temporary laid off workers. As for AHE, we think it's going to rise 0.3%. Which would be a modest step down after two straight strong months of 0.4%. But again, the bigger picture is that wage growth it's slowing, but it has stabilized, and so our forecast suggests that payroll income strength that's going to be supportive for consumers. So overall, labor markets steady and not falling off a cliff.
Okay, good one. Yeah, I guess markets have had a singular focus on the Middle East, of course, but that payrolls report is significant enough to attract attention. Hey, Rashir, good one. Let's end it there. Thanks so much. Have a great week ahead. Okay, now turning to Europe, Andres Stepaniak from Nomura's London-based research team is here, stepping up once again. Hey, Andre, thanks for being here.
Hey, Andrew, thanks for having me. It's always a pleasure.
Excellent. Hey, I noticed that you and the European research team put out a special report this week looking at the current situation, high oil and gas prices, and comparing that to 2022, when those prices also spiked after Russia invaded Ukraine. I think some have been suggesting that could be a useful playbook, but what's your take?
I mean, look, I think people have short memories, and so clearly the current conflict and the impact on energy prices, everyone's thinking to themselves, how similar is this to back in 2022 when we had that energy crisis in Europe? So firstly, there are a few key differences. The first being that the actual magnitude of shock is smaller, certainly on the gas front, than last time round. On the oil front, it's maybe slightly more acute. Also, monetary policy is slightly different. So before, it was very accommodative. This time round, actually, in the euro area, it's neutral. And in the UK, it's actually marginally restrictive to neutral. We had expected the Bank of England to still cut twice prior to the shock occurring. From the central bank's perspective, the real focus now is leaning against those second round effects. So you have the shock impacting directly the energy component. You then have the shock impacting indirectly things like airfares and so forth. But then it's about those inflation expectations making sure those are anchored, they don't de-anchor, and the whole idea being that if they do de-anchor, people might start to demand higher wages, which then sort of feeds through and creates a spiral, sort of wage price spiral we saw back last time around. Essentially, we think that the macro fundamentals this time around are different, and so the risk of second round effects in both the euro area and the UK is less likely this time around versus back in 22. In terms of looking at the UK versus the euro area, we actually think the euro area risks are slightly higher than the UK, and I think this is important because markets are pricing both the ECB and the Bank of England to raise rates by about 3 times by December of this year. So markets are pricing in the same response essentially. We think that's wrong. In reality, of the two central banks, if one was to raise rates, the ECB is much more likely than the Bank of England because the risks of second round effects in the euro area are higher than in the UK.
Okay, got it. Wow, a lot there. Okay, let's turn our attention to the data. We did receive PMI data this week and an IFO report in Germany. Those numbers generally looked a bit softer. What was the bottom line there for you?
Look, Andrew, I think there are two takeaways. First, we saw the activity side of things did weaken, so output fell. I think what was interesting at the margin was the services indices fell by more than the manufacturing indices. But based on the press release, it seems some firms are trying to get ahead of the curve, by which I mean output was slightly higher than it otherwise would have been, and also new orders were slightly higher than it otherwise would have been, because firms are trying to essentially plan for the risk of much longer disruptions further down the line if the war intensifies or if the Strait of Hormuz remains closed for much, much longer. And I think the other key takeaway in terms of the actual PMIs as well, really, is those price indices. Everyone was so heavily focused on the price indices, and you saw the input price indices rose markedly, both for manufacturing firms and for services firms. The output price indices, though, were much more contained. And I think from a sort of central bank or a market participant perspective, the key focus is in the upcoming PMIs, do you see the input price indices rise further? That's the one first risk. And secondly, more importantly, from a sort of inflation perspective, do you see those output price indices begin to rise meaningfully as we saw back in 22?
Okay, got it. Yes, we are a bit inflation focused at the moment. Andre, that brings me to the final question. Looking at the calendar ahead, CPI data's coming out for Europe. Have you got any quick thoughts there?
I mean, look, it's all about inflation. So yes, we have the March HICP inflation data for the euro area aggregate on Tuesday. In the days running up to that, we have country level data. But look, it's really all about the first direct effects we see with respect to the rise in oil prices and how that feeds into pump prices. We have weekly pump price data, and we've seen that rise quite meaningfully in the euro area. So for what it's worth, we're now forecasting HICP inflation on Tuesday, so the March figure, to be 3% year on year. That's a jump from 1.9% in February. And worth bearing in mind, prior to the Iran conflict, we were forecasting basically an unchanged print. So essentially, the direct impact, we think, in terms of pump prices and household energy bills, effectively is basically raised our forecast from 1.9 to 3%. So that's quite a shift.
Yeah, wow, that is quite a big jump. We're seeing something similar down here too. Hey, Andre, let's leave it there. Thanks so much.
Thanks, Andrew. Great as always.
Now, let's move to China. Hannah Lu from Nomura's research team is here with us. Hey, Hannah, great to have you on. It's been quite a while.
Thanks, Andrew.
Now, the conflict in the Middle East remains front and centre. Let's start there. What's the latest from China? How is China coping with the conflict?
If we think about the conflict from the impact directly or theoretically, China could be hurt because after all, it is the world's largest energy importer. It could be exposed to the growth headwinds in the face of any energy price shocks. Because if you look at any econ textbook, it would tell us that an elevated production cost could squeeze firms' margins and reduce households' purchasing power. But in practice, Beijing has many buffers to cushion this blow. On the one hand, we have seen that it has already utilized many toolkits to stabilize the domestic oil prices. For example, it has ordered guidance to tap into its vast national strategic reserves and also imposed export controls on refined oil products and also ordered some direct price control on the retail energy prices. And on the other hand, we have a rich alternative energy sources such as coal and renewables. Oil and gas only accounts for around 27% of China's total energy consumption. So there's plenty of buffers.
Okay, sounds like China's fairly well insulated, maybe better than most. Could there be any potential upside for China from all of this?
Yes, indeed. So, from my personal view, I think this conflict could, in the short term, make Beijing's task on inflation and growth a little bit more easier. Let's start with the growth side. So the short-term impact on the China's export is actually a plus because a price spike in oil could increase the global demand for China's low-cost renewable products, such as a cheaper EV cars or solar batteries. And on top of this surge in external demand, China could also potentially eating up other manufacturing countries' export share because of its very stable supply chain and extremely flat electricity prices, unlike the other countries. And on the inflation side, China has been trying so hard to drag the economy out of this deflationary trap in 3 years. And although this could be seen as an imported inflation, it doesn't mean anything is really improving on the domestic demand side. But actually, after all, it's still give a better look on inflation data print. For example, Beijing could saying some good words about its completing its agenda for reaching a decent number of inflation this year, thanks to its domestic policy of the anti-evolution campaign. And also in terms of the recent, this morning, we have seen the news that Trump is visiting China in May. And the likely negotiation outcome of this Xi-Trump meeting will be largely unchanged from the big picture. For example, we might see a 1-year pause on the escalated tariffs and on the rare earth export controls from both sides, and with China promising to purchase more U.S. agricultural products. But the outbreak of this conflicts maybe let Beijing could realize that it is pleasantly finding itself under a slightly better position. For example, with this rise in the fertilizer prices, U.S. farmers might find it the rise the cost of making this food production is rising, right? So China is a big fertilizer exporter, so it might have a bargaining chip also on the fertilizer side. on top of the rare earth exports. Yeah, so that is the basically, I think in the short term, if it's not escalated in a long term and evolve into a very extreme, like across the board inflationary spike, so China would be actually in a better situation.
Okay, that is interesting. Yeah, particularly the Trump-Xi meeting mid-May, I believe. I hadn't thought that China could have an extra bargaining chip with high fertilizer prices. Still, I guess there's a lot of water to flow under the bridge between now and then. Hey, Hannah, finally, let's just turn to the data, the calendar next week. PMI data for China will be out, and this is March data too, so it could be interesting. What do you expect to see?
So for manufacturing, we expect it to rebound to 50.0 in March from 49.0 in February. And for non-manufacturing, we expect it to also improve to 49.8 from 49.5. But however, this March PMIs are usually distorted by the seasonality due to the Chinese New Year holiday. So meaning that the February number could be quite a low base because of these less working days. So any rebound in the PMIs doesn't provide a meaningful gauge for the domestic activities. We're not seeing any turnaround for the weak domestic demand.
Hannah, that's great. Thanks so much.
Thank you.
Now, hopping over to Japan, let's get the latest from Yuichiro Nozaki from our Tokyo-based research team. Nozaki-san, thanks for joining.
Hi, Andrew.
So, on the Middle East conflict, I think it's understood that Japan is a large energy importer. So what's your latest thinking about potential impacts on Japan from the conflict?
I'm watching two main channels closely, higher crude oil prices and a decline in supply volumes. On the price side, Japan highly depends on Middle East crude oils, more than 90% of total import, and its import price are linked to not to Brent, but to Dubai. Dubai crude oil price has recently risen to around $150 per barrel, which is extremely high compared with other price benchmarks. So import prices are likely to swell to more than double their February level. The government has begun providing subsidies to cap gasoline prices, which should help contain any sharp rise in consumer prices for the time being. Under the current system, the impact on electricity and gas bills will not be reflected until June. However, if current price level persists, the reserve funds used to finance the gasoline subsidies could be exhausted by the summer, meaning that the government may need to compile a supplementary budget depending on how the situation goes. As for the impact of reduced supply volumes on production, it is not especially visible at this stage. The government has also moved to release oil stockpiles. We are hearing that reduced supplies of naphtha are beginning to affect the production of chemical products. There are also reports that oil refiners have told the government that supply restriction could emerge from July. So if the problem becomes prolonged, the impact on production could grow.
Hey, that is interesting. I like the way you've broken it into price and volume impacts. That's good economist delineation. And you mentioned naphtha there too. Yeah, I think we're getting just a real education on how high oil and gas prices are flowing through to various petrochemicals and other business inputs and impacting prices and outputs in a range of goods. Let's turn, Nozaki-san, to the data. The Tankan will be out next week, and that'll give us a different angle on business sentiment. What are you looking for there?
The Tankan survey to be released on April 1st will be one of the key checkpoints ahead of the BOJ's April policy meeting. Since the survey reference date is March 12th, some of the effects of the turmoil in the Middle East are likely to be reflected in the result. In terms of business conditions, the Tankan includes both the Current Condition Diffusion Index and Outlook Diffusion Index. For current conditions, I expect the DI to be broadly unchanged from the previous quarter, meaning that it likely remained at a solid level. By contrast, the Outlook Index likely deteriorated for both manufacturers and non-manufacturers, reflecting factors such as higher crude oil prices. In addition, the Tankan includes survey items on banks' lending attitudes and corporate financing conditions. Since this is the first survey following the BOJ's rate hike in last December, I think the bank will also be paying close attention to how these indicators have moved. As for April meeting, factors beyond the Tankan will be matter as well. Most importantly, how the conflict involving Iran develops and the BOJ branch managers meeting on April 6. The longer the turmoil in the Middle East continues, the lower the probability of an April rate hike becomes. It is close call, but we expect the BOJ to raise rates in June.
And finally, Tokyo CPI data will be out next week too. And this is March data, so that could be pretty interesting. What do you think this one will show?
The March CPI data will likely confirm that disinflation is continuing overall. We expect core CPI inflation, defined as all items excluding fresh food, to slow to 1.6% year-on-year, down from 1.8% in the previous month. The survey period for the March CPI coincided with the point at which gasoline prices began to rise in response to the increase in crude oil prices. Energy will therefore act as an upward force on inflation. On the other hand, post data show that the pace of food price increases slowed significantly between February and March. Overall, I think this downward effect will outweigh the upward push from energy.
Nozaki-san, that's great. Thanks so much.
Thank you.
And finally, a few quick words on other things to look out for across the broad Asia region next week. First up, Korea. We expect data next week to show that growth in industrial production and exports picked up, led by the chip sector. There are some working day effects in that data, but I think a solid trend is evident beneath the surface. We also expect Korea headline inflation to pick up to 2.2% year over year in March, with higher energy prices more than offsetting lower food prices. Elevated oil prices and a weaker Korean won are a threat to inflation stability, and we think that supports a likely hawkish policy stance from the Bank of Korea when it meets next April. Second, India. We expect industrial production growth to pick up to 5.5% year over year in February from 4.8% previously. Our team warned, however, that fuel shortages in the wake of the Middle East conflict will likely start to show up in industrial production data from March onwards, and there are early indications that firms are facing a fall in new orders and steep pressure on margins. So higher inflation and lower output growth ahead, it seems. That's not a great combination, but one which is likely to become increasingly familiar in other parts too. And finally, down here in Australia, minutes from the Reserve Bank's latest policy meeting will be out. That meeting saw a second back-to-back 25 basis point rate hike delivered in a very tight 5-4 decision. So we'll be looking out for further clues there into what the RBA is thinking about the path ahead. We do have another 25 basis point rate hike from the RBA penciled in when it meets next in early May. Okay, so there you have it, our views on major market themes and what to look out for next week. This podcast has been written by Andrew Ticehurst and Nomura's Global Markets Research Team and expertly edited and produced as always by John Dalton. Thank you for listening in. If you did enjoy this podcast or would like to hear more, please like and subscribe to Nomura's podcasts on Apple, Spotify and SoundCloud or wherever you go for your podcasts. And if you have a moment, please leave us a review. And as we always say, it would make our day if you could press a few buttons and share this podcast with a colleague or a friend. For more, log into nomuraconnects.com to keep up to date and to keep on listening. Thanks, goodbye for now, and see you next week.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.